the article that I was reading. So this article's viewpoint was, man, Social Security is broken. It's worse for those who are younger. It's likely not going to be there to the same degree that it is right now. This is a big problem for retirement in America.
Mm-hmm.
And they said, if we had just done something different than Social Security and allowed folks to take the money that they have been forced to put into Social Security taxes over their earning years and allowed that to grow at what the market has grown, how much better off would that worker be?
Mm-hmm.
And so the data was something to the tune of, a worker started at age 23 and their salary was about $60,000, that over the course of their working years by age 67, they would have contributed about $540,000 to Social Security.
Mm-hmm.
And they said, well, if you grew that to, an amount, I think it would have grown to about $1.5 million over those 40 years, roughly. And then you took out an annuity and you earned, call it 4.5%. Your monthly earnings, your monthly dividend from that annuity would be something around $6,000 or something along those lines.
Okay.
So you took all that Social Security that
$6,000 a month?
$6,000 a month.
Okay,
yeah.
Cool. So monthly cash flow of $6,000.
Yeah, exactly. So you took all that money that you put in Social Security taxes, and they just ran the numbers, and using rough investment numbers, they said, well, you could have turned that into $6,000 of income after investing for 40 years. And then they ran, well, what is the actual benefit over that time period for Social Security? And it's about $2,200. So they were showing that viewpoint of what maybe an average investor might do compared to, contributing to Social Security, which is nice to compare. But at the end of the day, you don't have that choice of whether or not to contribute to Social Security. So a little bit of a moot point there. But I thought it was cool to look at it from the investor lens, right? How much better off could we be? And for me, listen, I know that we're not going to solve Social Security on this show. I know that the road to solving that is long and tenuous, and there's going to be a lot of obstacles to do that. But what I do know is that we can take control of the controllables, and we can start to do things, especially when we're young, to take retirement into our hands and let the compounding benefits work in your favor. And especially when it comes to rental property investing, letting those 5 profit centers work for you and build over time. So where I took that original kind of exercise, which was more for investing in the stock market and bonds and annuities, and I flipped that on its head and I said, well, what if we invested in one rental property? And how would that compare to the contributions and the net payout of Social Security over that roughly 40-year hold? Interesting.
What'd you find?
Well, what I found is that it's pretty staggering, the differences here. So as I mentioned, if you contribute, we're going to start at one rental property. That's the power of compounding. That's the power of investing in an asset that is stable, reliable, consistent, and has above average returns, and buying and holding. You're taking control.